Good evening, everybody. From today, we are starting a series of four very special sessions of direct tax law at CA final level. In these four sessions, we shall be discussing various provisions applicable for different entities, assessment of different entities. This is what is our topic for discussion, and we shall be discussing this particular topic in the next four sessions starting from today. Okay. The idea is this, the overall scheme of income tax. There are various provisions related with the taxability of different types of income. Which income shall be taxable, in what manner, what deductions would be available, how an income shall be subjected to tax. These are various different provisions related with the income and then the deduction available from income. Now, all these provisions apply for all the assessees in the similar manner. The income under the head business profession is to be calculated for all the assessees in the similar manner, be it individual, HUF, company, partnership firm, for all the assessees. Basic provisions of business income chapter, capital gains chapter, house property, other sources, they all are same. But then there are various provisions in the Income Tax Act which are applicable with respect to a particular entity. If my assessee is a particular entity, then the special provisions will become applicable. So in these sessions, we shall be discussing all the provisions of the Income Tax Act which are applicable to particular entities. Till now, you must have studied the income tax with reference to income. Now we will be studying the income tax with reference to the assessee. If my assessee is a particular type of entity, what all special provisions would be applicable for that particular assessee, assessment of different entities. Okay. And as and as is the case with all my classes, let's try to keep all these classes as interactive as possible. In this particular session, we shall be talking about some very important issues related with the company assessment. Say again, a PPT focusing on the crux of every provision is what we will be using for the purpose of our discussion. And then we shall also try to do some calculations, some important calculation part of this whole discussion. That is also we will be covering in our today's session. Okay, so special provisions applicable for various entities. Okay, what all different types of entities we shall be talking about. Various special provisions applicable for the company, partnership firm, LLP, HUF, AOP, BOI, cooperative societies, mutual concerns, securitization trust, REIT, real estate investment trust, INVIT. These all are different special types of entities. Some of the entities, first of all, we would like to understand what these activities are actually, like securitization trust or REIT or INVIT, what these entities are. But the idea is this, various provisions which are applicable with respect to a particular entity is what we will be discussing. If in the examination, in the question, the examiner starts the question by saying that in the case of Messrs XYZ Private Limited, following details have been given. Because XYZ Private Limited, it's a company, then I should get alert that apart from all other provisions, certain special provisions which are applicable for the company, these provisions may become relevant for this particular question. Okay, so different types of entities. What are the special provisions applicable for a partnership firm, for HUF? If my assessee is AOP, BOI, then what special provisions would be applicable? This is what we will be discussing in these four sessions. Again, I'm repeating this thing, how to calculate taxable income, all the provisions related with the different heads of income, chapter 6A deductions, all these provisions are applicable for all the assessees in the normal manner. Okay, like I have mentioned, capital gains, whole capital gain, as it is applicable for individual, same it is applicable for company, partnership, HUF, every entity. What are the special provisions applicable for these entities? This is what we will be discussing. Okay, so let's start our discussion with by understanding in quite a detail a very important part of our final direct tax studies, that is assessment of companies. If my assessee is a company, it's a corporate entity, then what are special provisions applicable for determination of tax liability of the company? Corporate assessee, assessment of companies from the final level. This company assessment is something very important. The normal understanding is this, that whatever are the individual assessment issues, provisions related with the individual as an assessee, all these have been covered at the IPCC inter level. At final level, company issue becomes very important. So all these corporate assessment issues are something very important at the final direct tax level. So we shall be devoting a good amount of time in analyzing various special provisions applicable with respect to the companies, assessment of companies. Okay, fine. Now, uh, how to calculate taxable income of a company? There is no special provision. As I am saying again and again, as I calculate taxable income for any assessee, similarly, I calculate taxable income even for the company also. Then what are the special provisions applicable for the company? Okay. First of all, tax liability of a company. How to determine tax liability of a company? Now, the moment we talk about determination of tax liability of any entity, the simple idea which comes in mind that, okay, calculate the taxable income and then apply whatever are the rates of taxation applicable. In the case of company, the matter is not so simple. When we talk about tax liabilities of the company, not one, not two, not three, but even four different provisions become relevant for the purpose of determination of tax liabilities of the company. Whenever I have to find out how much is the tax payable by a company, I need to keep in mind provisions related with the normal tax calculation. I need to keep in mind something called optional lower rate mechanism. Then there is something called MAT, minimum alternative tax. And then there is something called BBT, buyback tax also. So for an individual, calculation of tax liability might be an issue of one single set of provision. Whatever are the slab rates based on this individual tax liability is to be calculated. But in the case of a company, the calculation of tax liability, I need to consider all these different provisions: normal tax, optional lower tax, MAT, buyback tax, all these four different provisions relevant for determination of tax liability of a company assessee. Okay. So now let's take them one by one. Let's start with this normal tax. Tax on the normal income. Okay. Normal tax liability of a company. What are the rates of taxation? Okay. In the case of individual, like we have three different slabs of taxation depending upon the age of the assessee. Up to 60 years of age, 60 to 80 years of age, and more than 80 years of age. These are three different slabs, three different rates of taxation for individual. In the case of a company assessee, the rate of taxation depends upon the nature of the company, whether it's a foreign company or it's a domestic company, it's an Indian company. Okay, so in the case of a foreign company, the rate of tax is 40%. Okay, we all know in the case of companies, there are no slab rate of taxation. Whatever is the income, that is taxed at a flat rate. So in the case of foreign companies, the rate of taxation is 40% flat. In the case of domestic company, now here matter become a bit complicated. Okay, With respect to domestic company, now what is the rate of taxation? The normal rate of taxation. Now, in case of a domestic company, the normal rate of taxation actually depends upon the turnover of the company. I cannot straight away tell anybody that this is going to be the rate of taxation for a domestic company, for an Indian company. What will be the rate of tax? That will depend upon what is the turnover, what was the turnover for the company. Okay. So now, in the case of a domestic company, if turnover was more than 400 crores, the rate of tax would be 30%. If turnover was up to 400 crores, the rate of tax would be 25%. Okay. So up to 4 crores and more than 400 crores. Up to 400 crores and more than 400 crores. Up to 400 crores is my turnover. My rate of tax is 25%. My turnover more than 400 crores, the rate of tax applicable for me would be 30% for a domestic company. Okay. Now, in this whole company assessment, there are lot many issues which are called, say, hidden bombs kind of thing. Small issues hidden somewhere, but unless and until you see these issues carefully in examination, you are bound to make a big mistake, a blunder kind of thing. Okay. So now, with respect to this company assessment, all these, say, small issue problems start from the first point itself. What is the rate of taxation? Depends upon the turnover. How much is the amount of turnover? What is the criteria? What is the threshold? 400 crores. Up to 400 crores turnover, 25%. More than 400 crores turnover, 30%. But more important is to keep in mind this turnover is for which year is to be seen. Now we are preparing ourselves for assessment year 21-22. That is previous year, financial year 2021. All this discussion is with respect to previous year, financial year 2021. So the moment I tell you turnover is up to 400 crores or more than 400 crores, the natural idea which comes in the mind is the year for which I'm calculating the rate of tax. The turnover for the same year is to be seen. Okay, so if I'm calculating tax liability for the financial year 2021, so turnover of 2021 is required to be seen. This is what is the, say, idea gets generated subconsciously in my mind. An examiner makes full use of this subconscious ideas which gets generated in my mind without me reading the provisions in an alert manner. The kind of trap which gets created for me. Now you are calculating taxable income for the financial year 2021. For this, you need to find out how much is the turnover. Now, be very clear. Note it down very carefully. For FY 2021, the turnover of FY 2021 is not to be seen. Okay, then may I see the turnover of the last year, that is FY 1920. Even it is also not to be seen. The turnover of FY 1819 is to be seen for determination rate of tax applicable for me for the financial year 2021. Be very clear. If I am your examiner, I will deliberately give you turnover for 2 years. I will give you turnover for FY 18-19 also. I will give you turnover for FY 2021 also. And invariably, FY 18-19 turnover would be less than 400 crores. FY 2021 turnover would be more than 400 crores. So that I'm able to plant a doubt in your mind. I'm able to plant a confusion in your mind. And in examination, the moment confusion gets creeped in the mind, the whole paper is lost. So be very clear, be very, see it with full confidence, see it with full alertness. The turnover for 18-19 financial year is to be seen. This may look something very awkward. This may look something very, say very unusual way of thinking that, okay, my FY 2021 turnover is 1,000 crores. FY 2021 turnover is 1000 crores, 18-19 turnover was 200 crore. I will still be treated as a company having a turnover less than 400 crores. My tax liability would be 25%. In current year, whatever is my turnover, absolutely not relevant. What is to be seen is the turnover for FY 18-19. Okay, I keep on suggesting this thing number of times. Whenever you read income tax, always pay attention to these small issues. These are reading between the lines. Everybody in the country would be memorizing these rates of taxation: 30%, 25%, up to 400, more than 400. Every CA student will be knowing this much. What is going to be the difference between you and others? You are seeing it carefully, not only 400 crores, but 400 crores for which year is to be seen. For PY 2021, for AY 21-22, the turnover of FY 18-19 is required to be seen. If it is up to 400, your rate is 25%. If that was more than 400, for current year, your rate would be 30%. Yes, this is possible. In FY 18-19, my company was doing great. So my turnover was 1000 crores. In current year 2021, I'm down. I'm down like anything. My turnover is only 10 crores. From 1000 crores, now I'm 10 crores. Still, my rate of tax would be 30%. So keep all these possibilities, keep all these permutation combination in your mind. That turnover for FY 18-19 is to be seen. Okay. Yeah. So now there is a question, Sumit from Jaipur, why 18-19 turnover is to be checked? Sumit, why is not the question to be asked in income tax? Income tax, whatever is written there, read it, keep it in mind, move forward. Okay. Why is probably a policy issue which somebody in parliament may answer. Okay. Yeah. Now, two common questions, Sumit Agrawal from Mathura and then Raman Sajdeva from Delhi. What if the company has been newly started? In the year 2021 only, if the company has been started, then what will happen? Very logically, if you started your company in 2021 only, 18-19, your turnover was zero, less than 400 crore. For 2021, your rate of tax for PY 2021, your rate of tax would be 25%. And say this may be another way of examiner creating a trap for you. They may not give you turnover at all. They will simply start by saying that in the case of Mrs. XYZ Limited, XYZ Private Limited, a new company formed in the year 2021, following are the details. Now you are very clear in your mind, sir, for rate of taxation, I need to see how much is the turnover. In whole of the question, the turnover has nowhere has been given. So the question is incomplete. And then I start writing blah, blah, blah in my answer sheet. Examiner has given you a hint. When he has said in the case of Mrs. XYZ Private Limited, a new company, that means he is giving you a hint that for FY 18-19, the company was not in existence. Its turnover was zero, less than 400 crores. So for current year, your rate of tax would be 25%. Okay. Okay. So the rate of taxation in company assessment, the problem starts from the very first point itself. I rarely pay that much of attention to the rate of taxation issue. This is, I feel, is something very basic, very normal, but not very basic. It requires to be seen very, very carefully. So I hope now all of those who are say with us right now have got this idea absolutely formed up in your mind. For FY 2021, the rate of tax of the company shall depend upon the turnover for FY 18-19. Okay, first learning of the session. Fine. Now come to surcharge and cess. What are the surcharge? What are the cess? Again, the purpose of my whole session is not to waste your time in giving you those information which are already available in the books, in the say institute study material, whatever other sources you are referring. There are certain information which are already available. So my purpose is not to waste your time into those things. My purpose is to give you something which is not very obvious, something which you may not get an idea by simply reading something. So those hidden issues, those important aspects which should draw attention of a CA student, these points we would like to highlight a lot in this whole discussion. Okay. Fine. So now surcharge and cess. This is what is simple. There's nothing much to be discussed here. What needs to be discussed, that will be in the next slide. But before this, what is the basic provision? The surcharge. For the company, now there are different slabs of surcharges depending upon different types of companies. Different rates of surcharges depending upon different types of the companies. Okay. If my turnover, my income, not the turnover, my taxable income exceeds rupees 1 crore, then only surcharge would be applicable. For the company, the threshold for surcharge starts from 1 crore. Okay. For different entities, there are different threshold. For individual, surcharge starts after 50 lakhs of taxable income. For company, the surcharge starts after 1 crore of taxable income. So if my taxable income is more than 1 crore, the rate of surcharge would be 7% or 2%. Domestic company 7%, foreign company 2%. If my taxable income is more than 10 crores, then the rate of surcharge would be 12%, 5%. Okay, this is something simple. So only when the income is more than 1 crore, the surcharge would be payable at the rate of 7 or 2%. If the income is more than 10 crore, surcharge would be payable at the rate of 12 or 5%. Okay. One small point only, 1 crore or 10 crore, more than 1 crore, more than 10 crore. What should be more than 1 crore, more than 10 crore? Those who were with me in my earlier two sessions regarding this deductions of income, in the very first session, I mentioned this thing. There is something called gross total income and there is something called total income or taxable income. Now, gross total income and taxable income, gross total income and total income. What is the difference? Chapter 6 deductions. So whenever Act is talking about a GTI, it is talking about income before Chapter 6 deduction. Whenever the Act is talking about taxable or total income, it is talking about post Chapter 6 deduction. So now with respect to surcharge, what is required to be seen? With respect to surcharge, what is required to be seen? Sorry. Is whether I need to see the gross total income or the taxable income, whether I need to see income before deductions, chapter 6 deduction, or income after chapter 6 deduction. Okay. The wording used by the act is taxable income, total income. That means this 1 crore, 10 crore is not my gross total income. It is my income after chapter 6 deduction, whatever is my final taxable income. If it is more than 1 crore, then surcharge is payable 7 or 2%. If it is more than 10 crore, then surcharge is payable 12% or 5%. Okay. Raman is having a very interesting doubt. I hope this doubt may not be there with others, but let me clarify. When again we are talking about taxable income, are we talking about income under the head of business? See, my business income is only one head of income. Business income, capital gains, income from other sources, these all are income under different heads. Aggregate of all these five heads of income, that gives me my GTI, gross total income. From that gross total income, when I give all these chapter 6 deductions, after chapter 6 deduction, what I get is my taxable income, my total income. Okay. So what is 1 crore or 10 crore here for the purpose of surcharge is my final taxable income. This is possible. My business income might be 90 lakhs. Then I may have a long-term capital gain of 20 lakhs. So as a company, now my income is 1.1 crore. Surcharge would be applicable. So we are not talking about business income only. We are not talking about income under any one head. We are not talking about income before chapter 6 deduction. We are talking about my final income, all heads taken together after chapter 6 deduction. Whatever is my final income, that will be my taxable income for the purpose of surcharge. Okay. After surcharge, then the cess is normal 4%. Okay, for the AY 21-22, the rate of cess is 4%. Tax plus surcharge, the cess is payable. This is something simple. Okay. So learning for this particular slide, the point to be noted for this particular point is this: 1 crore or 10 crore is my taxable income. Okay, taxable income. What exactly is the taxable income? Now we all get this idea very clearly. Okay, fine. So rate of taxation, surcharge and cess. Then we come to next and a very important topic related with this surcharge only. A very important point. Why it is very important? Because it has got to say some small complicated calculation involved. So understanding that calculation is important, and conceptual clarity is also something very important with respect to this particular point. The concept of marginal relief. Related with the surcharge, there is this concept of marginal relief. Whenever a surcharge is applicable, the marginal relief concept also applies. So in remaining sessions, when we will talk about individual or partnership firm, there also surcharge would come to picture, and there also this concept of marginal relief will be relevant. Here, with respect to company assessment, we are trying to get a basic clarity about this concept of marginal relief, but that will be applicable for all other assessees whenever the surcharge is payable. Okay. So now what exactly is this concept of marginal relief? It is related with the surcharge. If surcharge is there, then marginal relief may be there. So in the case of a company, if my income is up to 1 crore only, then there is no surcharge, then there is no marginal relief also. Marginal relief may come into picture only when there is a surcharge. Now, what is the idea of this marginal relief? In certain cases, surcharge may be less than 7% or 2%. We are talking with respect to a domestic company only. Concept would be applicable similar to foreign company, but from examination perspective, this domestic company is obviously the main idea. So all our discussion is with reference to domestic company now. Okay. This is, again, I'm repeating something very important. We will be discussing this whole concept of marginal relief in a very different manner. I would try to simplify this very complicated concept. I would try to simplify it as much as possible. So listen to it with all your alertness. Okay. Those of you who are sitting with your smartphone on, your say social media is also on side by side. If it is there for next 10, 15, 20 minutes, please switch off everything. Just focus on this concept of marginal relief. Okay, we will be discussing it in a very simple kind of manner, very different concept we will try to generate. Okay, yeah. So the basic idea related with the marginal relief is this: that in certain cases, though my income is more than 1 crore or 10 crore, surcharge may be less than 7% or 12% in some cases. That is what is the idea. Let's try to develop this idea further. Okay, so now what is the concept of marginal relief? In the case of a company having total income exceeding rupees 1 crore but up to 10 crore, the surcharge of 7% in case of this domestic company, 7% rate is the surcharge. But now marginal relief says that the total of income tax plus surcharge shall not exceed tax on rupees 1 crore income plus excess of my total income over rupees 1 crore. Whenever I am calculating surcharge, I need to keep in mind this aspect also, that though normally surcharge is 7% or 12%, but that is only half of the story. That is only one part of the story. That surcharge is 7% or 12%, that is only one part of the story. The another part of the story, and then only concept will get complete, is that if the company's total income is somewhere between 1 to 10 crore, the surcharge would be 7% of my tax liability. But at the same time, my total of income tax plus surcharge should not exceed what? Tax on rupees 1 crore income plus excess of total income over 1 crore. This much amount would be the maximum income tax plus surcharge. So I will calculate surcharge first in the normal sense, that is 7% if my income is between 1 to 10 crores. And then I will check whether the total income plus surcharge exceed this maximum limit. It cannot exceed this maximum amount. What is this maximum amount? Whatever tax I was required to pay at 1 crore income plus whatever is the income over and above 1 crore. Whatever is the excess income I have earned over and above 1 crore, that amount plus my tax liability at 1 crore income. This is the maximum amount. Maximum of what? Maximum of total income tax plus surcharge. Okay. In the next slide, we will be discussing all these this concept by generating certain numbers. But right now, try to get it at the conceptual level itself. Okay, then we will make it a bit easier by generating certain numbers. But in the first shot, try to get it at a bit harder level, at a bit tough level itself. Okay, at the conceptual level. So this is what is the first concept. If the income is somewhere between 1 to 10 crore, my surcharge rate would be 7%, but at the same time, my total of income tax plus surcharge cannot be more than tax payable on 1 crore income plus excess of total income over rupees 1 crore. Okay. Before we generate certain numbers in order to simplify this jugglery, let's generate another concept here itself. That is, when my income is more than 10 crore, then the surcharge is payable at the rate of 12% of my tax. Okay, and this is one more important pointer. Surcharge is 7% or 12% of tax. It is not of income. I hope we all are clear on that part. Okay, so if my income is more than 10 crores, surcharge normally is at 12% of my tax. But again, the total of income tax plus surcharge shall not exceed tax plus a surcharge payable at the income of 10 crores plus excess of my total income over rupees 10 crore. Okay. My simple suggestion would be to all of you who are watching this webcast is just have a click of this particular slide. Just have a screenshot. You will require it. This is whole concept of marginal relief summarized, simplified into one single screen. Though it may look difficult as of now, but we will simplify it further by generating certain numbers, and then this concept would look like something very simple. So right now, just get a picture of it. Just get a copy of this particular slide. Marginal relief surcharge may be less than 7% or 12% in some cases. What exactly is the concept of this marginal relief? Again, if my income is somewhere between 1 to 10 crores, rate of surcharge would be 7%, but at the same time, total of income tax plus surcharge cannot be more than tax payable on 1 crore income plus excess of total income over rupees 1 crore. If my income is more than 10 crore, surcharge rate would be 12%, but at the same time, total tax plus surcharge cannot be more than tax plus surcharge on 10 crore income plus excess of my income over rupees 10 crores. Okay. Now let's try to simplify this whole concept further by generating some examples, and let's generate this example. Let's try to get this concept in a step-by-step manner. Okay, I'm trying to create a complete step-by-step visualization for each one of you. The way this whole PPT has been designed in a step-by-step manner, a visualization should get created in the mind of each one of you. What exactly is this concept of marginal relief? How to calculate the surcharge? Okay, I can calculate the surcharge directly at the rate of 7%, 12%, but then I may miss out on the important concept. So what should be the exact foolproof process of calculating the surcharge? If the total income is 1 crore, then the tax payable, say company is into 30%. Like for all our example, we are assuming that the rate of tax applicable for the company is 30%. So if 1 crore is my taxable income, tax at the rate of 30% would be 30 lakhs. Obviously, zero would be the surcharge. Income is only 1 crore, not exceeding 1 crore. Up to 1 crore, no surcharge is payable. So this is the normal case. Now, tax plus surcharge would be 30 lakhs. Okay. Now, the question starts. The problem starts. And the examiner will start testing you now onwards. The total income is 1 crore, 1 lakh. If total income is 1 crore, 1 lakh, I can keep in mind I am having excess income of 1 lakh. For this whole marginal relief surcharge calculation concept, I need to find out how much is my income in excess of 1 crore. So excess of income is 1 lakh. I can just keep it in mind for the time being. But then if 1 crore, 1 lakh is my income, my tax liability at the rate of 30% would be 30 lakhs 30,000. If you are having a calculator also handy with you, you can also do this calculation on your own. Though these calculations are perfect, but when you do calculation in your hand, with your hands, the confidence builds up. So 1 crore, 1 lakh is total income at the rate of 30%. The tax would be 30 lakhs 30,000. Now a surcharge is payable. Income is more than a crore. So surcharge payable, the rate of surcharge is 7%. 7% of my tax. So 30 lakhs 30,000, 7% of this. If you will do this calculation, your calculator should give you the figure of 2,12,100. Okay, fine. So those of you or those of the students who have not studied the concept of marginal relief, they will say that, okay, if the income is 1 crore 1 lakh, the tax plus surcharge payable would be 32 lakhs 42,100. Okay, those students who have read only half of the provision, who know only half of the story, then the tax plus surcharge would be 32 lakhs 42,100 for them. But those who have taken pains to read it completely, to grasp the concepts in a proper manner, for them now the remaining part of the calculation. What is my rule? The surcharge is 7% of tax, but at the same time, my tax plus surcharge cannot be more than tax plus surcharge on income of 1 crore, that is 30 lakhs, plus excess income, that is 1 lakh. So my surcharge, okay, I have already got certain answers in the chat box. Good. So in this case, my tax plus surcharge would not be 32 lakhs 42,100. It would be only 31 lakhs. Okay. 7% surcharge would not be applicable here. The maximum limit will come into picture. And as per that maximum limit, 31 lakhs would be the tax plus surcharge payable here. I will calculate my cess on this 31 lakhs. So 4% cess would be payable further 1,24,000. Okay. So normal 7% concept, the surcharge payable is 32 lakhs 42,100. With this marginal relief concept, the tax plus surcharge payable would be 31 lakhs. So meaning thereby my assessee would get a relief of, my assessee is getting a relief of 1,42,100, which is called marginal relief. Okay, fine. I tell you what happens, why this concept becomes very, very complicated. Because in almost all the reading material, they start by calculating marginally. And then they calculate what is the final amount payable. Actually, the calculation should be opposite, should be reverse. How much is the final amount payable? Normal amount payable with 7% surcharge would be 32, 100. With this concept of maximum amount payable, the tax plus surcharge would be 31 lakhs. If I do this calculation, then the marginal relief calculation becomes automatically whatever is the difference, 142, 100 is my marginal relief. Okay, the target is not to calculate the marginal relief. The target is to calculate what is the final amount payable by the assessee. So final amount payable by the assessee in our case is 31 lakhs. On this, cess would be calculated, the surcharge calculated at the rate of 7% and surcharge calculated in tax plus surcharge calculated at with the 7% surcharge rate, and tax plus surcharge calculated in this manner. The difference of this is marginal. Okay, fine. So with this, now let's have a problem for each one of you. Total income is 1 crore 2 lakhs. Do a quick calculation. Tell me how much is the tax plus surcharge payable in this case, and how much would be the marginal relief available to the assessee. Give me both the figures. Do your calculation. Send me your answers in the chat box. What I want, how much would be the tax plus surcharge payable, and how much would be the marginal relief available. Okay, make it fast as possible. You are sitting in examination. The time is not much. We are having login from almost all parts of the country. East, west, south, north, central, all parts of the country are logged in. Let's see from where we get our first correct reply. How much is the tax plus surcharge payable, and how much is the marginal relief available? Okay, so we have got our first answer, and then this answer is, I'm really happy to announce, is absolutely correct. Remya R from Thiruvananthapuram. Okay, then followed by Ambika from Mumbai. Correct answer. Raman from Delhi, you may like to recheck it. Manoj from Noida, you may also like to recheck it again. Our rate of tax is 30%. Raman, still probably you need to recheck. Okay, okay, fine. So let's see now, for all of those who are continuously sending your answers. Yeah, most of these answers are correct. Somewhere there is some problem I see. Okay, let's see again. What is the calculation? Okay, 1 crore 2 lakh is my total. So now I'm having an excess income of 2 lakhs, which I will be using for the purpose of by that maximum payable calculation. Okay, tax at the rate of 30%. So my tax liability comes to 2 lakh 14,000. My tax liability comes to 30 lakh 60,000. Then surcharge at the rate of 7%. A normal calculation of surcharge will give me to 14,200. And then this means my tax plus surcharge would be 32 lakh 74,200. And those who don't know the concept of marginal relief, for them this would be the answer. But then, actually speaking, the tax plus surcharge payable would be 32 lakhs. Tax plus surcharge payable would be 32 lakhs. How come it is 32 lakhs? Tax plus surcharge on income of 1 crore 30 lakhs plus my excess income 2 lakhs. So maximum tax plus surcharge payable would be 32 lakhs. Normal tax plus surcharge is 32,74,200, but using this concept of marginal relief, my tax plus surcharge payment comes down to 32 lakhs. Cess on this would be 4%, 1,28,000. Okay, how much would be the marginal relief I am getting? Difference between 32,74,200 and 32 lakhs, 74,200 would be the marginal relief. Okay. Hema from Chennai, correct answer. Nitesh from Seeker, correct answer. Muthu Lakshmi from Madurai, right. Sumit from Mathura, right. Hema from Chennai, right. Okay. 74,200 would be the marginal relief in this case. Fine. Let's move forward. We will be spending good amount of time on this whole surcharge and marginal relief calculation. Okay, because I'm sure you won't get this kind of clarity at other places where you will be getting here. And this is something very, very important. If the question comes in the examination where the marginal relief calculations is involved, I'm very sure 9 out of 10 will not be able to do it correctly. Okay, you should be that 1 out of 10. Okay, so we will be spending some more amount of time. Okay, Nitesh from Seeker, why marginal relief before cess? Again, Nitesh, why is not a question to be asked in income tax. Yeah, just this is like this. Okay, whatever is the law, whatever is the provision of that, read it, move forward. Okay. So now, Raman, you are getting it clearly. Fine. So now let's move forward. Let's do some more calculations on this, some more thing. Now we are discussing, right now we have discussed with reference to 1 crore income. Let's do a calculation with respect to 10 crores income. And the concept will remain same. The calculation would also be same. A small variation would be there. But let's prepare ourselves for this situation in examination also. They may give you figures with respect to of this level where the income is 10 crores or more than 10 crores, and then the marginal relief may come into picture again. Okay. So now what would be the situation with reference to that 10 crore or more? If my income is 10 crores, tax would be still at the rate of 30%, 3 crores. Surcharge would be payable. And the moment income is more than 1 crore, surcharge is payable. So at 10 crores income, the surcharge payable would be 7% of this 3 crore, that is 21 lakhs would be the surcharge payable. So tax plus surcharge at 10 crore threshold would be 3 crore 21 lakhs. This figure is going to be very, very important for you. The amount payable at the threshold is 10 CR. At 10 CR, the amount payable is not 30% 3 crore. That is, amount payable at threshold is 3 crore 21 lakhs. And here some may commit a mistake. So you should be clear on this aspect now. At 10 crores, the amount payable would be 3 crore 21 lakhs. If my income is now say 10 crores 5 lakhs. If my income is 10 crores 5 lakhs, what will happen? The excess income over threshold is 5 lakhs now. Tax still rate of tax is 30%. So 3 crore 1 lakh 50,000 would be the tax payable. If you do the calculation, your calculator would also give the same figure as my calculator has given. So 3 crore 1 lakh 50,000 would be the tax payable. Normal surcharge would be 12% now. So 12% of this would be 36 lakhs 18,000. Tax plus surcharge 337.68. 10 out of 9 students in the examination will do this calculation. Will stop at this figure. For them, 337.68 would be the correct answer. Not for us. We would like to test. We would like to apply the concept of marginal relief. Okay. Now, what the concept of marginal relief says? Tax plus surcharge cannot be more than amount payable at 10 crores income that we have calculated 3 crore 21 lakhs plus excess income. In our case, this is 5 lakhs. So my tax plus surcharge payable at 10 crores 5 lakhs cannot be more than 3 crore 26 lakhs. By 12% concept, it is 337.68, which is not possible. The maximum amount I would be paying would be 3 crore 26 lakhs. Okay, on this I will be calculating cess. 13 lakhs 4,000 would be the cess amount payable. How much would be the marginal relief available in this case? 337.68 minus 3.26, difference 11,68,000 would be the marginal relief applicable. Okay, 11,68,000 is the marginal relief. I always say this thing. We are studying all this, all these taxation and everything to pass the examination. That is okay. But we are also studying all these concepts to be applied in a real life situation. Now imagine the case. You are having your own practice of chartered accountancy. One client comes to you, 10 crores 5 lakhs is his income. He went to some other places and some other chartered accountant has told him that, okay, your tax plus surcharge would be 337.68. Okay, you have that concept of marginal relief clear in your mind, and then you have calculated, no, your tax plus surcharge would be 3 crore 26 lakhs. 11,68,000 relief you have given to that particular client. If I give a relief of 11 lakhs to a client, how much fees I can charge? And I always say income tax is the only subject in your syllabus. Any one concept you are able to use once in your lifetime, probably the whole expenditure of your CA studies would be recovered. 11 lakh 68,000 relief if I'm giving to a client, how much fees I can charge to him. Okay, so all these concepts, yeah, we are studying it for examination purposes, but at the same time, I can use it in a real life situation also for generating a real advantage for my client, and in the process generating a good advantage for myself also. Okay, so now my tax payable would not be 337.68, it would be 3 crore 26 lakhs plus a cess. Okay, 10 crores 5 lakhs is my income. The tax plus surcharge payable will be calculated accordingly. Okay, so very quickly, another question for you. If my total income is 10 crores 10 lakhs, again, can you calculate the tax plus surcharge payable and the marginal leave available? And I'm sure this time you can do it real fast. 10 crores 10 lakhs is my income. How much would be the tax plus surcharge payable? How much would be the marginal relief available? Yeah, I already got the first answer and this is correct. I'm holding on to the name. Let others also come out. Yeah, next answer is also correct. Okay. This is real good. This feels so good. Almost every answer is correct. Yeah. First correct answer is again from Remya, Tiruvananthapuram, Nitesh from Sikar, next Muthulakshmi from Madurai, Hema from Chennai, Raman from Delhi, and all these answers are absolutely correct. Yeah, Sumit from Mathura, Ambika from Mumbai, Manoj from Noida. Great. Manoj from Noida, you can just check your marginal relief again. Answer is correct that way. Yeah. This is good. Okay, for all of us, let's see it very quickly. 10 crores, 10 lakhs is my income. Excess income over and above threshold is now 10 lakhs. Okay, so tax on this 10 crore 10 lakhs at the rate of 30% is 3 crore 3 lakhs. Normal surcharge calculation 12% would be 36,000, 36 lakhs 36,000. So accordingly, my tax plus surcharge payable would be 339,36,000. However, the concept of marginal relief comes into picture. My maximum amount payable, tax plus surcharge level, maximum amount payable cannot be more than 3 crore 21 lakhs plus excess income of 10 lakhs. So total amount payable by way of tax plus surcharge would be 3 crore 31 lakhs. On this 3 crore 31 lakhs, I will be paying a cess of 4%. How much would be the marginal relief available? 3 crore 39 lakhs 36,000 minus 3 crore 31 lakhs, 8 lakhs 36,000 would be the amount of cess marginal relief available. Okay, I'm again repeating, this is real good, or everybody has got it correct. And then I can tell you, once this whole discussion is over, you can go out and try it on your friends. Okay, all your other friends doing CA, and somebody might be talking a lot about his detailed studies to you. Just test this. Okay, give him this 10 crores 10 lakhs kind of figure and ask him to calculate the tax liability. Okay, ask him to calculate the final amount payable. Pretty sure not many people would be able to do it correct. Okay, you can find out. Okay, you can try it on yourself. Fine. So this is how the marginal relief, this is how the surcharge is to be calculated. Just keep in mind 7% and 12% may not be always payable. Okay, just check out, just check out whether the marginal relief is available or not. Okay, now you all may be able to see that this marginal relief is available only when income is marginally above my surcharge threshold. In this case, we are calculating with respect to 10 crores 10 lakhs. Probably if we do the calculation with respect to say 10 crores 30 lakhs, then the normal surcharge of 12% would be payable. Marginal relief will not come into picture. That's why the name is marginal relief. When income is marginally above the surcharge threshold, then this marginal relief may come into picture. So probably in examination, if you have been given figure of say 13 crores as taxable income, then no need to consider this marginal. You can calculate the surcharge directly. But if the examiner has framed the question in such a manner where taxable income is coming slightly above the threshold limit, then marginal relief would be required to be considered. Okay. This is what is the calculation part. This is how the calculation is to be done. Now, more important, one more important aspect, and typically about the examination mindset. Despite of knowing provisions very clearly, despite of having an absolute fantastic grip on the calculations, I make blunders in examination, specifically with respect to direct tax. Why? Because direct tax paper has got one very specific aspect about it. The uniqueness is this: number of cases in the question, what is to be done, it is not mentioned in the question. I needed to alert, I needed to keep in mind all the possibilities that this calculation may also get involved. In the examination, if examiner has to is interested in getting this marginal relief calculated from you, do you think he will write in the paper, please calculate marginal relief, please consider marginal relief also here? We all know CA examiner doesn't believe in all these please kind of thing. They will deliberately frame the question in such a manner where your taxable income would be marginally above the threshold. Okay, Now the very practical aspect of it in the examination, okay, all that pressure cooker kind of situation, somehow you have done whole of the question, all these addition, deduction, allowance, disallowance, doing everything. At the end, now you have got the taxable income, and then you have to calculate the tax and the surcharge. Because this is going to be the last kind of calculation of the question, your mind would be so fagged out kind of thing that you will simply may not be able to consider, yeah, there is something called marginal relief also. This happens, you will be simply doing that whole calculation. This is the income, this is the tax, this is the surcharge, and end of it. Okay, be very clear, the last calculation of the question may have got a real twist involved in it by way of margin relief. So if the question has been designed in such a manner where taxable income is coming just above the surcharge threshold, that means examiner is interested in testing your marginal relief knowledge. He will not say it in so many words. He will not say it clearly. This is you who need to remain alert about this particular possibility. Marginal relief. Okay. Whenever surcharge is there, marginal relief calculation is there. We will again discuss this concept when we will talk about individual and partnership firms, but the basic detailed idea we have generated in our today's discussion with respect to corporate associates when income is more than 1 crore, and in the second case when the income is more than 10 crores, how the surcharge is to be calculated. Okay, fine. I will not leave you at this point with the marginal relief. We will do one more calculation related with this. Okay, this is going to be the real complete clarity about this margin relief. And this time, this is what is the question for you. Okay, take your time, do your calculation, calculate the tax payable including cess. You need to give me the final figure. Two companies, both are having same income, but the rate of tax differ. Do your calculation. And you can take my words, those of you who will be able to answer this question correctly, you can rest assured about your DTL paper in examination. Okay. Don't try to rush. No need to send me the first correct answer, but try to send it correct. Take your time. Now, this is an exam question. Huh? You need to be very clear what actually has been asked. I'm not asking you about the amount of marginal relief. I want you to give me the tax payable including cess. So give me only two figures for company A and for company B. How much is the tax payable including cess? In examination, writing unnecessary things may also deduct your mark. Huh? Raman, you are giving me only tax surcharge figure. I need tax surcharge including cess. Ramya, probably you have also not given me the figure including cess. Yeah. Hema from Chennai has sent a correct answer. Ambika from Mumbai has sent correct answer. Manoj from Noida. You have not included cess, I think. Nitesh from Seeker. With respect to B, you are correct. A, you may probably check it again. Yeah, Raman from Delhi, absolutely right. Okay, Preeti, I can see the first answer coming from you. Preeti is somewhere called D. Why it is D? Okay, I assume Preeti from Delhi. Okay, okay, both the answers are correct. Great. Manoj from Noida. This is really good. Manoj from Noida, except one typing mistake, I think, but your answer is correct. Manoj Singh from Noida. Okay, from Noida to Madurai, Muthulakshmi. Okay, could you just check with respect to company B, Kathmandu Limited, Muthulakshmi from Madurai? First, you are right. Second, actually, is the company where the crux is. Okay, okay. So happy to note most of you are getting it correctly. Okay. And as I have said, mark my words, those who are getting this question correctly, you can say rest easy about your DTL paper in examination. Yeah, same level of study, same level of passion. If you are able to maintain till May, DTL should be a cakewalk for each one of you, those who are getting it correct. Mark my words. Okay, Nitesh from Seeker, right. Okay, let's see it very, very quickly for the benefit of everybody and those who will be say seeing it on YouTube later on. Let's see very quickly the calculation. Now the total income is 1 crore 3 lakhs. First case, 30% is the rate of tax, 30 lakhs 90,000. 7% surcharge would be 216,300. I need to test it. The total amount would be 33,600, okay. Now I need to test it whether it is crossing the maximum amount. My tax plus surcharge at 1 crore threshold would be 30 lakhs. Excess income I am having 3 lakhs. So my tax plus surcharge cannot be more than 33 lakhs. As per the normal 7%, it is coming to 33,600, 6,300. It cannot be more than 33 lakhs. So my tax payable would get restricted. My tax plus surcharge payable would get restricted to 33 lakhs. 4% cess on this would be 1,32,000. The final tax payable would be 34,32,000, including cess and everything. Marginal relief of 6,300 I will be getting. Okay, Leela from AP, I can see the first answer coming from you in all our sessions. With respect to A, you need to check it again. Now you should be able to see where is the difference coming in your answer. Okay, so first company, A Limited, Kathmandu Limited, 30%, the tax plus cess plus surcharge, everything all inclusive payable would be 34,32,000. Okay. Now coming to Indore Limited, 25% case. Okay, this is where the real catch is. This is CA examination. Be very clear. The land is always slippery here. They won't give you a time to say recover unless and until you are alert. So second case, the income is 1 crore 3 lakhs. Tax liability 25%, 25,000, 25 lakhs 75,000. Okay, 7% surcharge would be applicable here. Tax plus surcharge would be 27 lakhs 55,000 to 50. What about this whole marginal relief? Now at 1 crore income, my tax would be, my amount payable would be 25 lakhs. The excess income is 3 lakhs. So considering this aspect of calculation, the maximum amount payable comes to 28 lakhs. Whereas as per normal calculation, I'm already paying less, 2755 to 50. That means the marginal relief will not be available in this case. And a marginal relief is applicable in every case. Nobody has said this thing. Marginal relief concept tells me the maximum amount which is payable. As per my normal calculation, already I am paying a lower amount, then that will be treated as the final amount payable. So 2755 to 50 would be the tax plus surcharge payable. On this, the cess at the rate of 4%, 110,210. The total amount payable would be 28,65,460. Yes. Now Muthulakshmi from Madurai, you have got it correct. Sumit from Mathura, right. Okay. So friends, this is what is the whole idea related with the surcharge calculation. And with respect to company assessment, we are discussing only the first point, how to calculate the tax liability. And believe me, most of the people feel that the tax calculation is the easiest part in the income tax. Okay, not much of the issues are involved, but now we are saying there are issues, and if we are not very alert, despite of doing everything else correctly, at the last we might commit a blunder in the examination, unnecessary facing the problems. Okay, so with respect to company assessee, the rate of tax 25%, 30%, 400 crore turnover, which year is important? One thing, surcharge 1 crore, 10 crore, the rates of surcharge, you might be knowing it already, or you can read it at all the places, rates of surcharge. But with respect to surcharge, this whole marginal relief calculation, this is what which you cannot get a clarity number of places. Rate of surcharge, even Google will give you, these are the rates of surcharge. So this session is not about teaching you all those things which you can get from other places also. This session is about developing an expertise over these important, smaller, but very, very important concepts. So I hope now you all must be feeling very, very confident about calculation of surcharge. What exactly is the concept of marginal relief must be clear to each one of you now. Okay. So this completes our say first part of discussion with respect to the corporate assessees, the basic normal rate of taxation. Okay, I think at this point of time we can have our break of this particular session. After the break, then we shall be talking about this new section, new provision regarding this 115 BAA, BAB, and other provisions. It is 7:23 in my watch right now. So as usual, sharp at 7:38, we will restart this discussion. Okay, sharp 15 minutes break. Thank you. Okay. So, welcome back. In the first part of this session, we have covered our discussion regarding the normal rate of taxation applicable for a corporate entity, and where we have discussed in quite detail this whole concept of surcharge along with marginal relief. Okay. Okay. Uh, then we come to the second part of our this discussion. And meanwhile, in the chat box, I have got a number of messages. Thanks you for all the appreciation which you are giving. The whole idea is to discuss all those issues which really require a detailed discussion, where as a CA final student, you need to have a detailed, minute, proper understanding. These are all the areas we are trying to cover in this discussion. Okay, something which you can get from everywhere, that is already known to you. So we are focusing on more important issues, more say complicated part of our discussion. Fine. So now we come to second part of our discussion, that is this new concepts coming into income tax, optional lower rate mechanism. From last year, that is this financial year 1920, assessment year 2021 onwards, these two new sections have been introduced in the tax laws, where the domestic companies have been given an option to go for a lower rate of tax mechanism. They can opt for a mechanism where their rate of tax would be lower as applicable to all other companies. Okay, so let's have a complete idea about this whole new mechanism. Two sections, 115 BAA applicable for all the companies, and then 115 BAB applicable for new manufacturing companies. Okay, so what are these provisions? Okay. Both of these sections, 115 BAA and BAB, are providing an optional rate of tax regime. Okay. What are these rates? The first point of our learning here would be for all domestic companies, the optional rate would be 22%. New manufacturing company, the optional rate would be 15%. This is an option which they need to exercise. How it is to be exercised and everything we will be discussing. But they can go for the normal rate, what we have discussed earlier, or they can go for the special lower rate. There is an option available. So all domestic companies, 115 BAA, new manufacturing companies, 115 BAB, 22%, 15%. In this regime, there is a mandatory surcharge of 10%. Okay, whatever is your income, regardless of the quantum of income, in this optional mechanism, the surcharge is mandatory 10%. And then there is this cess, normal 4% cess. This is applicable in this case also. Okay. So effectively speaking, the rate of tax would be 22% plus 10%, 24.2 plus 4% of this 24.2 would be the final rate. Similarly, new manufacturing company, 15% plus 10% of 15, that is 16.5, and 4% of the 16.5 would be the final tax impact under these options. Okay. Now, one very important part, there is this whole concept of MAT, which we will be discussing in detail later on. But if the companies go for this particular option, then MAT would not be applicable. Okay. Along with MAT, there is a concept of MAT credit also. Earlier years MAT credit is being carried forward. If this option has been exercised, since MAT would not be applicable, the MAT credit would also be lost. It will also no longer remain available. Okay, this is what is the basic structure of these two sections. Okay, now what is the option? Lower rate of tax applicable. If rate of tax are lower, then obviously they are giving me some benefits, then they must be taking away something also. Otherwise, everybody would go for this lower rate of taxation. So what is the trade-off? Okay, the calculation, the decision, rate of tax would be lower, 15 or 22%, but then certain special benefits would not be available. Some benefits which are available to a company for its normal income calculation, these benefits would no longer be available if you go for these options. That means if company goes for this new section, then certain deductions which are otherwise available, they will no longer remain available. What are these special benefits not available? Deduction under section 10AA, SCZ deduction, not available. Under section 32, this depreciation calculation, there is this concept of additional depreciation. 20% of the cost of new machinery, additional depreciation may be claimed by the assessee. In case company go for this new optional rate mechanism, then that additional depreciation would not be available. Normal depreciation will be available. This additional 20% depreciation available in the first year of the installation of new plant and machinery, that is not available for this optional mechanism. Then this section 32 AD, investment allowance, 15% of cost of new machinery. If certain conditions are fulfilled, then this 32 AD investment allowance is allowed. That is also not available here. Then in respect of tea, coffee, rubber business, 33 AB, there is a deduction available. That is no more available here. 33 ABA with respect to this mineral oil, natural gas, petroleum, etc. That 33 ABA deduction no more allowed. Section 35 AD, in respect of certain businesses, even capital expenditure are also allowed as 100% deduction in the first year itself. Okay, but if company go for these new sections, then this 35 AD deduction would also not be available. The list continues. Section 35 triple C, 35 CCD, agriculture extension project, this development project expenditure, all these are not available. Section 35 scientific research expenses. Now, if we can recall, section 35 deduction with respect of scientific research expenditure has got various different subsections related with the deductions. Different kind of deductions are available in section 35. So out of all those section 35 deductions which are available on the basis of payment made to outsiders, that is say this approved scientific research association or to national laboratory, etc., those deductions would not be available. Okay. Similarly, in the same section 35 scientific research, there is a deduction on account of approved in-house research facility where the weighted deduction is allowed. If you go for this option, then that approved in-house scientific research facility deduction is also no more available. This is important. Any deduction under chapter 6A part C except 80JJAA. Now part C, we have discussed this in my last session also. Part C of chapter 6A is all about these various income based deductions. Okay, so various special income deduction is allowed. If go for this optional lower rate mechanism, then all these part C deduction would not be available except 80JJAA. 80JJAA would be allowed, but all other part C chapter 6A deduction shall not be available. Okay, then whatever these deductions which are not available, if there is any carried forward loss, carried forward depreciation attributable to above deductions, that can also not be claimed by the company. Normal carried forward loss, normal carried forward unabsorbed depreciation, that would still be available. But say for example that additional depreciation 20% is no more allowed. In the last year, company had claimed the 20% additional depreciation, and that is a part of company's unabsorbed depreciation. Now company cannot carry forward that much unabsorbed depreciation. Okay, So now what is happening? These all are various deductions, mainly of PGBP chapter. So when we are now studying PGBP chapter, you need to have a clarity. You need to mark it there that this deduction, normally it is available to all the assessees. These deductions are available. But for the company who is going for this optional rate mechanism, these deductions would not be available. While studying those deductions itself, you need to develop that idea. So now you can do a marking in your say books with respect to all these sections, whatever given in these two slides, that these deductions are not available for companies who are opting for the lower rate mechanism. Okay. So this is what is the basic idea. Every company has to do a calculation. If these deductions are not claimed, then what will be the tax liability? If these deductions are not claimed, then what would be the tax liability? And then going for the optional rate mechanism would be beneficial for the company or not. Every company has to do this calculation, lower the rate vis-a-vis foregoing all these deductions, not claiming all these deductions. Okay. Now, how this option would be worked out? As we are saying, this whole new structure is optional. Okay. Now, if it's an option, it needs to be exercised. When it is to be exercised? It is to be exercised before the due date of filing of ITR. Okay, so company has to exercise it before due date of filing of ITR. Okay, if company fails to exercise this option, then the normal rate would be applicable. Okay, meaning thereby, by default, normal rates apply. Only when you specifically exercise this particular option, then only you will be entitled for this special rate of taxation. Okay, now now, amongst this optional mechanism also, there are two different sections, 115 BAA and 115 BAB. BAB applicable for this new manufacturing companies. Okay, so this new manufacturing company, they have to exercise this option in the first year of operation itself. 115 BAA option may be exercised in subsequent years also. Okay, the current assessment year, that is AY 2021, is the first year of application of both of these sections. Any new manufacturing company, it has to exercise this option in the first year of operation itself. Other companies who are exercising option in 115 BAA, they may decide to exercise this option in the current year. They may exercise this option in the subsequent years also. But for the new manufacturing company, this option needs to be exercised in the first year itself. Okay, after the company has been formed, the option is required to be exercised. Okay. Now, this is something very, very important. Option once exercised, it cannot be withdrawn. That's why before exercising this option, you need to take a very clear-cut call whether this option is to be exercised or it is not to be exercised. It is once in a lifetime kind of situation. Okay, once exercised, you cannot withdraw it. Okay, you cannot come out of it. However, you yourself cannot withdraw it, but then act will throw you out in certain cases if you fail to satisfy the conditions which are there for the applicability of this option. If these conditions have not been fulfilled by the assessee, then the option will become invalid and then you will be into the normal rate mechanism. So on your own, you cannot withdraw it. But if you commit a mistake, there is a non-compliance of any of the condition, then the option would not be available for you. Okay. Yeah. Now, with respect to this new manufacturing company, 115 BAB. There are certain further special conditions for all the companies 115BAA, 115BAB, how the option is to be exercised that we have discussed. Now, what exactly is a new manufacturing company where the rate of tax is only 15%? All other companies you can go as low as 22. But new manufacturing company 115BAB, the incentive is very, very high. 15% would be the rate of tax, very, very low rate of tax. Okay, so some special conditions for this manufacturing companies, new manufacturing companies. Okay, the first condition is this: it should be a new manufacturing company that is must be set up and registered on or after 1st of October 2019. From PY 1920, this whole scheme has started. So 1st October 2019 or anytime thereafter, the company must have been set up and registered. Okay. Then starting date is 1/10/2019. The last date is 31st March 23. The manufacturing or production must be commenced by this particular date. After 31st March 23, this window will get closed. It will no longer be available. So it's a very, very time specific kind of section which has been introduced. Company formed on or after 1st of October 2019, commencing the manufacturing up to 31st March 23. Okay, then this should be a new company. New company, that means not formed by splitting up, reconstruction, revival of a business already in existence. Those of you who were there with me in the last session where we have discussed that section 80 IAC, the startup, there also the similar requirement was there that startup should be a new entity. The business should not have been formed by splitting up, reconstruction, revival of an already existing business. Same concept is applicable here also. Okay, by way of this particular section, government actually wants to increase the manufacturing capacity in the country. Okay, global economic scenario, we all know this China competition is happening, so government wants to create a manufacturing base in India in order to tackle those Chinese matters. So government wants that more and more new manufacturing facility should get set up in the country, and that's why the special 15% rate has been created. Now there is already an existing business, you simply revive it, you simply reconstruct it, simply to take benefit of this particular lower rate. This is not possible, and that's why they have said that business should be new one, should not have been formed by revival, splitting up, reconstruction of business already in existence. Okay. However, and this also we have discussed with respect to section 33 80 IAC, if there is a revival reconstruction under section 33B, that is business has been closed down due to any natural calamity and then it has been revived due to any reason beyond the control of SAC, if the business has been closed down and then it has been revived, that revival is okay. Otherwise, the business should be a new business. Okay, some more conditions for this new manufacturing company. Now it should be new. Second is it should be manufacturing. And if we read the name itself very carefully, we get both the ideas. It should be new, and second, it should be manufacturing. So how to ensure it is manufacturing? Company should not be engaged in any business other than manufacturing or research related to that manufacturing. So you have to do only manufacturing or production, research, and then distribution of these articles, whatever you are producing, distribution of these articles. Okay. Now, another requirement, it should be a new company. That means old business should not be revived. And then in order to ensure that it's a new company, the second condition is this: out of this total value of plant and machinery used for the business, maximum 20% can be second-hand plant and machinery. At least 80% plant and machinery should be new. Maximum 20% you can use as second-hand, but minimum 80% should be this new plant and machinery. However, in this case, any machinery which has been imported from a foreign country, that will be treated as new. That will not be treated as second hand. Again, you can recall similar condition was there with respect to that ATIAC also. Okay, so new manufacturing company, it should be new, it should be engaged in manufacturing. Okay, few questions which are there in the chat box. Sumit Jain from Jaipur, manufacturing means, okay, Sumit, manufacturing, there is a definition given in section 2, which is common with respect to, say, all other places wherever the manufacturing has been defined. Basic idea with manufacturing is new product should come out of that particular process, then that will be treated as manufacturing. Okay, there is a further clarity about manufacturing in this section also that we will be discussing later on. Sumit Agrawal, whether section 80M is available? No, no part C deduction are available when you go for 115 BAA or 115 BAB. Okay. Sumit Jain from Jaipur, can LLP is also covered under 115 BAB? Those we are talking about company. Okay, corporate assessment of entities is our topic. So we are specifically discussing with the companies, not any other entity. So these provisions are applicable only and only for the companies. LLPs are treated as partnership for income tax. So for them, this BAA, BAB is not applicable. Okay. Yeah, Raman, your query would be answered in the, say, next few slides. Okay. Then one more requirement with this new manufacturing company, old plant and machinery condition we have discussed. And then there is a condition related with the building also. Any building which was being used earlier as a hotel or convention center, that building should not be used for the purpose of this manufacturing company. Okay, this is one more condition the law has given. Okay. Now, if any of the year there is a breach of these conditions that we have discussed in the earlier slide also, then this option BAB will not be available. If there is a breach of these conditions in any of the year, say for example, company starts any other business other than manufacturing, they start doing something else also, then this 15% tax option would not be applicable. In this case, company may exercise the option of the 22% because that is applicable for all the companies. These conditions are specific for 15% option, 22% option is applicable for all the companies. So if there is a breach of these conditions, then company would be thrown out of this 15% option, but then the company may exercise this 22% option in such case. Okay, now what is manufacturing? Manufacturing, the business of manufacture or production of any article or anything, it will include certain businesses and it will exclude certain things also. It should be a manufacture or production of any article or anything. It will include generation of electricity also, but it will not include development of computer software. That will not be treated as manufacturing. It will also not include mining. It will also not include conversion of marbles blocks into slabs. Okay, these all are some specific kind of activities which have been taken out from the purview of this section. So this will not be treated as manufacturing. Now be very clear, any company which is not engaged in manufacturing, it cannot go for 15% option, but it can always go for 22% option. That option is available for every company. This 15% is specifically for manufacturing. So this whole inclusion and exclusion into manufacturing is relevant only for that 15% option. Okay. Then bottling of gas into cylinder, that has also been specifically treated as not manufacturing for 115 BAB purposes. Printing of books, production of films, that has also been specifically taken away from the definition of manufacturing. And then government may notify other businesses also which will not get benefit of this 15%. 22% is applicable for everybody. Okay. Yeah. Again, Sumit from Jaipur, foreign companies not covered, only for the domestic companies. Okay. Ramya from Thiruvananthapuram, BAB applicable for company distributing electricity? No, generation of electricity. It has to be generation. Manufacturing, basically we are talking. So you have to manufacture something, and generation of electricity is a kind of manufacturing for this section. But distribution electricity not covered here. Generation and distribution, then that is okay. Pure distribution, then this is not covered here. Then you can go for 115 BAA. Okay. Now, with respect to this 115 BAB, 15% new manufacturing company. Now there are certain other issues also. If they have some other income, okay, they cannot engage in any other business, but still they can have some other income. Okay, for example, bank interest. And if they have to do a business, there will be bank account, there will be bank interest. So any income which is not related, not incidental with the manufacturing of production. Okay. Now, what will happen to that income? That income shall be taxed at the rate of 22%. Only manufacturing activity related income, that business income 15%, other income taxed at the rate of 22%. From that other income, no deduction shall be allowed. This is important. Whatever deductions are to be claimed, that can be claimed only against that manufacturing business. This other income shall be taxed on a gross basis at the rate of 22%. Okay. Non-depreciable capital asset have been transferred. Short-term capital gain generated from them, that will also be taxed at the rate of 22%. That's a special clarification given by them. Okay, non-depreciable capital asset, any land, etc., have been transferred. Short-term capital gain arising from this, that will also be taxable at the rate of 22%. Okay. Yeah, Sumit Agrawal from Mathura, your question is being answered just now. Now, another issue related with this new manufacturing company, something called excess profit. Okay, what may be the situation that the business of this company, where the rate of tax is applicable 15%, the business of this company and any other person, any other assessee, his or her business, now they have been so arranged that this 15% company gets some excess profit. We have deliberately arranged our affairs in such a manner that this 15% company gets more profit. Okay, there is this group where there are two companies, two subsidiary companies of the same holding company. One subsidiary is eligible for this 15% rate, one other subsidiary is a normal company. So what group may plan? They may arrange their affairs in such a manner that this 15% company gets a higher profit. The other company gets a lower profit. Higher profits are earned by this 15% company, because here the rate of tax would be low. So overall tax liability of the group will go down. So if this have been arranged in such a manner that extraordinary profits are generated to the 15% company, then what will happen? The assessing officer may recalculate the profits of this company. Okay, applying the concept of arm's length price, assessing officer may recalculate the income of this particular company in order to ensure that any extraordinary profit, any excess profit does not get taxed at a lower rate. Okay. The provisions of this specified domestic transaction, the transfer pricing provisions would be applicable in this case. If volume of transaction is more than the limit applicable for a specified domestic transaction, then that whole transfer pricing concept would also be applicable in this case. So in order to ensure that this 15% company, only genuine profits get taxed here, any artificial arrangement has been done because of which unnecessary extra profits are taxed here, then assessing officer will have a right to recalculate your profits. If the transactions are more than the limit applicable for the specified domestic transaction, then even transfer pricing provisions, arm's length price concept would also be applicable. Okay. Whatever are these excess profits determined by the assessing officer, these excess profits shall now be taxable at the rate of straight away 30%. So whatever are the ordinary profits, they will only be taxable at this 15%. Any extraordinary profit as calculated by the assessing officer, they shall be taxed at the rate of 13%. Okay. This is what is all about this special rate of taxation, the optional lower rate mechanism. 15% and 22% is the rate of taxation. So far as rates are concerned, 10% surcharge is always applicable with respect to these companies. Certain special benefits will not be available to these companies. Certain conditions are there which they are required to comply with. How the option is to be exercised on or before the due date of filing of ITR. In a case of manufacturing company, the first year itself, whenever they will be filing their first ITR, they have to decide whether they want to go for this or not. In the first year itself, they have to exercise this option. All other companies may exercise it later on also, but once exercised, then it cannot be withdrawn. Okay. One query, Nitesh from Seeker. If company produces computer with its own software, then it is covered under 15%. In my opinion, yes. If the software are along with the computers, you are basically manufacturing computers. In the process, you are producing software, you are eligible for this 15%. Okay. Yeah. Now, related with this optional rate mechanism and related with my normal rate of tax discussion also, one very small but a very important point of discussion, income which are taxable at special rates. For domestic companies, there are certain income which are taxable at special rate. The normal rate we have talked about 30% or 25%, then that optional rate we have talked about 22% or 15%. Then there are certain income specific rates also. This 25, 30 or 22, 15 was the company specific rate of a particular type of company. This rate would be applicable. But then there are certain income specific rates. Certain income shall be taxable at a special rate, not at the rate of that 30 or 25 or 22 or 15. Special rate would be applicable with respect to certain income. Okay. So first case is this, tax on dividend received from the foreign subsidiary. Section 115BBD. My assessee is a domestic company. Domestic company, normal income might be taxable at the rate of say 30%, 25%, or if they have exercised the option 22 or 15%. Okay. Four different possibilities are there, 30, 25, 22, 50. Okay. Now this domestic company is having a special income. What is that special income? Dividend. Which dividend? From a foreign subsidiary. Subsidiary where I have 26% or more of equity share capital. So I have a foreign company in which I am having 26 or more percentage of share capital. This is my foreign subsidiary. From this foreign subsidiary, I am deriving dividend. This dividend is taxable at a special rate of 15%. This dividend is taxable at a special rate of 15% without any deduction. On a gross basis, whatever dividend I have earned of this nature, this will be taxable at the rate of 15%. 115BBD. Simple section. Okay. But again, as I'm saying again and again in this whole discussion, we are trying to focus more on the hidden aspects of the provision, something which is not very obvious, something which is not very visible, but which is very, very important. Okay. So this 115BBD section is something very, very simple. This is the type of income. This is the rate 15%. Okay. So first let's generate a comprehensive idea for an Indian company. The normal income might be taxable at the rate of 30% or 25% or 22% or 15%, depending upon the situation of the company. These are four rates of normal taxation. But then if this income is there, then this income shall be taken out from my normal income, taxable at the rate of 15%. All other income shall be taxable at the 30, 25, 22, 15, whatever is the situation. But more important with respect to this income is again understanding the idea of surcharge. Surcharge is a problem. We need to develop an absolute clarity. Now there are two sets of companies. One is taxable at 30-25%, second taxable at 20-15%. 20-15 is those 115 BAA, BAB. If they exercise this option, then they go to this 20-15 category. They don't exercise the option, then they remain in 30-25% category. For all the categories, this income is taxable at 15%. Now, what about surcharge? If the company opts for that 115 BAA BAB, it is into 20-15%. Still, this income shall be taxable at the rate of 15%, but then the surcharge would be mandatory 10% applicable here. With respect to normal rate and optional rate, the surcharge is a very important issue. In case of this optional rate, surcharge is always applicable regardless of the quantum of income. Normal rate 30-25%, surcharge comes into picture only after 1 crore. Okay, so with respect to this income also, if a company is covered in 115 BAA BAB, opted for this, then surcharge would always be applicable. 15% is the rate for this company plus surcharge. Companies who have not exercised this option, for those companies, surcharge shall depend upon their total income. If my total income is more than 1 crore, then for all of my tax liability, surcharge would be 7%, including tax payable with respect to this income also. If my income is more than 10 crores, then the rate of surcharge is 12%, including tax payable on this income also. Okay. Raman's question, sir, in this case, marginal relief is available. Marginal relief is available only when the company is covered in the normal rate mechanism. For 115 BAA BAB, there is no marginal relief concept because here surcharge is always payable. There is no threshold kind of thing in 115 BAA BAB. So for these companies, 10% surcharge concept of marginal relief is irrelevant. Other companies, marginal relief is applicable. This particular income, 115 BBD, 15% would be the tax. Surcharge would be additionally payable or not. Depends upon whether company has exercised this option. If yes, then additional 10% surcharge is always payable. If company has not exercised this option, then surcharge payable or not depend upon what is my total income. Okay, fine. So this is 115 BBD, special rate of tax on the dividends received from my foreign subsidiary. One more clarity related with the special rates regarding those sections which you have discussed already, which you have studied already. But let's see these sections again with respect to the companies. Now, there are certain other income also which are taxed at a special rate for all the assessees, like 111A, 112, 112A, 111A, 111A, that is with respect to short-term capital gain, STCG paid, 112A, that is LTCG, STT paid LTCG, STT paid STCG 111A, STT paid LTCG 112A, and then all other long-term capital gains taxable at the rate of 20%, 112. So we know this. You have studied this already. You must have studied this already. 111A 15% short-term capital gain, 112 20% long-term capital gain, 112A again share market STT paid long-term capital gain 10%. Now these income are earned by a company. What will happen? they shall remain taxable at the special rate itself. The rate of taxation, as we have discussed for the companies, all those rates are applicable for normal income of the company. The special income for which a special rate has been prescribed, this special rate is applicable even for the companies also. Okay, so all these income, 111A, 112, 112A, whatever is the special rate mentioned in these sections, that special rate is applicable, relevant even for the companies. Even if company has opted for this 115 BAA BAB, there was a question regarding LTCG for these companies. Somebody has raised this question. Yeah, Raman from Delhi, I think. So for the benefit of everybody, even if company has opted for 115 BAA BAB, income covered under 111A, 112, 112A shall remain taxable at the same rate which has been mentioned in these sections only. So say for example, if this is a manufacturing company, 115 BAB, normal income taxable at 15%, a long-term capital gain, normal long-term capital gain taxable at 20%. Okay, so whatever rates mentioned in these sections, these rates will have, you can say, an overriding effect over whatever is the special rate prescribed even under section 115 BAA BAB. This is something very, very important. You need to generate an absolute clarity on all these jugglery. This is what the CA final is all about, right? So 115 BAB, my normal income 22%, 15%, the special income taxable at the rates mentioned in these sections only. Again, what about surcharge? If company is covered in 115 BAA BAB, then apart from this normal rate, 10% surcharge is always applicable. Okay, so now see it very, very carefully. For this 115 BAA BAB having this special income, the rate of tax is coming from this particular section where the income is getting taxed. Surcharge is coming from this section where the company is getting taxed. Company is getting taxed under section 115 BAA BAB. That section is providing surcharge. The income is getting taxed under section 112. So 112 is providing the rate of tax. And this is what is the solid jugglery of tax laws. And that's why they say Indian income tax laws are probably the most complicated piece in the world. And the rate of tax is coming from one section, the surcharge is coming from another section. So another section that is applicable for the company, their surcharge is mandatorily 10%. If the same income has been earned by other companies who have not opted for this lower rate of taxation, whether they will be paying surcharge or not, that again depends upon their total income. Okay, something of a very complicated concept. I hope I'm able to simplify it a bit for you at least, and I hope you are able to get it properly. Special rates of tax with respect to income, and then the surcharge with respect to the company. Okay, so this is all about rates of taxation with respect to corporate tax. This is our first part of understanding what will be the different rates of taxes. We have not discussed about calculation of income and which income taxable under which section and what deductions are available and what all this is not discussed. This is only and only about the rate of taxation, finding the correct rate of taxation. Once you have calculated your income correctly, now what will be the rate of taxation in different scenarios for different companies for different income? But this is all about calculating the rates of taxation. Okay, again I am repeating, rates of taxation, as a student we normally take it very, very lightly. So rate of taxation, calculation of income is everything. Once income has been calculated, tax so we can calculate very, very easily. I hope we are able to realize this thing, that in the case of a company, that tax calculation itself is going to be a real task kind of thing. Okay, fine. So now we move forward. Whatever time remains in today's session, then we can cover the next important topic related with the company assessment, a new kind of tax applicable on the company, something called BBT, share buyback tax, section 115 QA. Whatever is my normal income, whatever is my normal tax, that we have discussed already, the tax on my normal income, tax on my special income, all this discussion we have covered. Now there's a small topic, that is in the case of a company, there's something called a buyback tax which is applicable. Okay, what is this share buyback tax? Very simply, as the name itself gives me an idea, whenever a domestic company buy back its own share, the company is buying back its own share from the shareholder. No income is being generated to the company, but still an additional taxes payable by the company. So simply, we are talking about a transaction under which a company is buying back its own shares from the shareholders. The company is required to pay an additional tax. The rate of this tax is 20% plus 12% surcharge mandatorily applicable plus 4% cess. Okay, BBT buyback tax, 20% tax plus 12% surcharge plus 4% cess. Okay, on which amount this tax would be payable? Very simply, the amount paid by the company at the time of buyback minus the amount received by the company at the time of issuance of the shares. The difference amount is taxable in the hands of the company on which the buyback tax BBT is payable. Company has issued the shares at 125. Today it is buying back at rupees 175. The difference 50 is the amount on which company is required to pay buyback tax, share buyback tax. Okay, those of you who are in touch with the say current economy, who read some kind of financial newspaper, they might be knowing that right now today itself two buybacks two large scale buyback are open. One is buyback by TCS and second is buyback by Wipro. Both these IT majors are buying back some percentages of their share from the shareholder. So both these companies must have done this calculation, the share buyback tax. Okay, 20% plus 12% mandatory surcharge plus 4% cess tax plus surcharge. 4% of this is the cess payable. Okay. Now, this buyback tax is payable is an additional income tax. Okay, whatever is my normal tax liability over and above this, BBT is payable. This is possible. I may not be required to pay any normal tax. My normal tax liability would be zero. Still, if I have done any buyback of shares, BBT would be payable. Okay. Now, this tax is required to be paid within 14 days from the date of payment to the shareholder. Within 14 days. My normal tax liability I can pay after the end of the year, but this BBT I have to pay immediately. The date on which payment has been made to shareholder, 14 days from this, the BBT is required to be paid. Whatever tax has been paid, you cannot claim it as an expenditure. You cannot claim it as a deductible expenditure. No deduction shall be allowed with respect to the amount of this tax. Okay. Now, within 14 days, you have to make the payment. If you fail to pay this much amount within 14 days, interest at the rate of 1% for every month or part of the month shall be payable. Okay. And then company shall be treated as assessee in default. All the provisions regarding collection and recovery of taxes in case of default in payment of tax would be applicable on the company also. Within 14 days, the payment has to be done. Otherwise, these would be the consequences. Now, a very important idea related with buyback taxes, check treatment for shareholders. Now, company is required to pay buyback tax. What would be the treatment for the shareholders? Though it is not related with the company assessment, but it is related with the buyback of shares. So we are covering this point here itself. Now, very simply, section 10, subsection 34A says that any income arising to a shareholder on account of buyback of shares is a fully exempt in the hands of shareholders. So what will happen whenever my shares would be bought back by the company? I will have a capital gain. Say for example, reset example, Wipro is buying back its own shares. I have purchased the shares of Wipro. Now Wipro is buying it back from me. I have purchased the shares for rupees 200. Now Wipro is buying it back for 300. 10 difference of this 100 rupees is capital gains for me as a shareholder. I should keep in mind Income Tax Act section 1034A says that whatever is the income to the shareholder because of buyback of shares by the company, that income is not taxable in the hands of shareholders. For shareholder, it is fully 100% tax-free exempted income. Company is paying buyback tax. Shareholder shall not be paying any tax on this income buyback tax. So as a shareholder, if I sell my shares in the market, then capital gain is taxable for me. If I sell shares through buyback, then whatever is the capital gain, that is not at all taxable in my hands. Okay. Sumit from Jaipur, concept of gross up is here. No, whatever is the difference amount, on that difference amount, straight away 20% plus 12 plus 4% tax will be payable. Okay, if company is paying tax on difference between buyback price and issue price, then such difference is included in total income? No, it has nothing to do with the income of anybody, neither the income of the company nor the income of the shareholder. For the shareholder, this is exempt. For company, whatever is the difference on this buyback tax is payable, but it has nothing to do with my total income. Okay. Yeah, so this is all about share buyback tax in the hands of the company and in the hands of shareholders. Those of you who have studied earlier dividend distribution tax provision DDT, you should be able to recall that this BBT is something related with the dividend, something similar to dividend distribution tax DDT. Okay, so this is all about buyback tax BBT. Okay. Then we cover one more small topic for our today's discussion, the detailed discussion about a very large topic of MAT that we shall be taking up in the next session. But before this, one more small topic related with the company, provisions applicable at the time of liquidation of companies. Okay. When company go for the liquidation, then certain special provisions become applicable with respect to the company and then with respect to the shareholder also. So what are these special provisions which are applicable at the time of liquidation of the company? Okay, what happens at the time of liquidation of the company? uh, sh- Assets are distributed to the shareholder. We all have studied liquidation from accounting perspective. Once the company goes into liquidation, all its assets are sold and the proceeds are distributed to the say different creditors, and then payment is made to the shareholders. Now, Income Tax Act says that at the time of liquidation, if companies' assets are distributed to the shareholder, then when the company distributes its asset to the shareholder at the time of liquidation, this distribution is not treated as transfer. Company is transferring its assets to the shareholders. This transfer is not treated as taxable transfer. No capital gain liability shall be there on the company. This is the one provision we are having under section 46(1) related with the liquidation of the company. But what is very, very important here, this whole provision is relevant only when company is distributing assets to its shareholders. Say for example, there is this company was having two shareholders. Various assets were there. Company has gone into liquidation. Different assets have been used for payment to different creditors. At the end of everything, company has left with one house. Two-story house was there, and these two shareholders were there. All other assets have been used, all other creditors, lenders have been paid off. Finally, company has left with one house, two-story house, and then these two shareholders. Fortunately, both these shareholders were real brothers. So it has been decided that ultimately this house will be disposed of to the creditors and company will be wind up, will get liquidated. Okay. Now the company is transferring its asset, this house, in favor of shareholders. Normally, any transfer of capital asset creates a capital gain liability. Section 46(1) says that if company has distributed its asset to the shareholder, this will not be treated as taxable transfer. Capital gain liability shall not be there. But then what happened in our story, both these brothers, they got into a fight. Who will take ground floor and who will take first floor? It was a two-story house. So ultimately it has been decided, rather than creating all these problems, let's sell off this house first. Whatever proceeds we will earn, these proceeds will be distributed amongst the shareholders 50-50. The moment company decides to sell the house, then that capital gain exemption would not be there. Even if the house is being sold only for the purpose of final distribution amongst the shareholders, still the exemption is available only when assets are distributed amongst the shareholders per se. Per se, that means as it is, whatever are the assets in the same form, in the kind of form itself, if the assets have been distributed amongst the shareholders, then the capital gain exemption would be allowed to the company. If company has first liquidated, realized, sold off these assets, then the transaction of sale will be taxable. Whatever proceeds you have received, you are distributing among shareholder, that is exempt. So what is exempt under 46(1) is the distribution of assets, specifically assets in a kind of form itself. If you are distributing, then the capital gain would not be there. If for the purpose of distribution, you have first sold off these assets, then distributed the money, sale of the asset is not exempt, the capital gain liability would be there. This is the first part of our understanding related with the treatment in the case of liquidation. Okay. Now the second issue related with this. From the angle of shareholders now. Now there is the section 222C, which says that if any distribution has been done at the time of liquidation by the company, company was having share capital also, company was having accumulated profits also. Okay, say for example, 10 lakhs share capital was there and 20 lakhs accumulated profits were there, and then company has distributed 25 lakhs to its shareholders at the time of liquidation. After doing all other say settlement payments, finally company has left with 10 crores capital, with 10 lakhs capital, 20 lakhs accumulated profit, and then 25 lakhs was the money available with the company. So that 25 lakhs has been distributed among the shareholders. The question comes, does this 25 lakhs represents share capital or it represents accumulated profits? 10 was the share capital, 20 were the accumulated profit. Total 25 distribution has been done. So this 25, whether it is 10 of capital and 15 of profit, or it is 20 of profit and 5 of capital. Section says that whenever any distribution is done by the company to the shareholders at the time of liquidation, whatever were the accumulated profits of the company immediately before its liquidation. When the liquidation is started, whatever was the quantum of profit with the company as on the date of commencement of liquidation, to that extent, whatever distribution has been done by the company, that will be treated as distribution of dividend and not the repayment of capital. So in our example, the share capital of the company was 10 lakhs. When the liquidation has started, the accumulated profits of the company were 20 lakhs. 10 lakh share capital, 20 lakhs accumulated profits, total 30. After liquidation, all sale plus minus everything, company is finally left with 25 lakhs of bank balance, which company is distributing amongst its shareholders. As per law, since as on the date of commencement of liquidation, my share capital was 10, accumulated profits was 20. Now I'm distributing total 25. 20 shall be treated as dividend given by the company. 5 will be treated as a repayment of capital by the company. Okay. 10 lakhs and 20 lakhs liability side figure. This 20 lakhs is the accumulated profit on the date immediately before the liquidation, the date on which my liquidation proceedings have started. That is the accumulated profit we are looking at. So that was 20, 10 was the share capital, total 30. Company has distributed 25. As per law, as per section 222C, out of this 25, 20 shall be the distribution of profit, 20 shall be treated as dividend, 5 shall be treated as repayment by the company. Now for the company, doesn't make any difference. Practically speaking, this whole discussion has got no relevance for the company. Company has distributed 25 and for the company, the matter is over. The importance of this whole discussion is with respect to the shareholders. Now, shareholders are getting 25. Out of this 25, 20 shall be treated as dividend in their hands. 5 shall be treated as repayment of their capital. So in the hands of shareholder, how this will be taxable? Now, whenever there is a liquidation of company, company is distributing its assets in the hands of shareholder. There is a capital gain liability in the hands of shareholders also. Because now the rights of the shareholders are getting extinguished, their shares are getting extinguished. So there is a transfer in the hands of shareholder also. In our example, now shareholders are getting 20 lakhs, 25 lakhs from the company. Out of this 25 lakhs, they are getting 20 lakhs as dividend. They are getting 5 lakhs as repayment of their capital. Okay. So what will be the tax treatment in the hands of the company? For capital gains purposes, the sale consideration would be not the total amount received by the shareholder, and this is where the crux is. This is where the mistake happens. Okay, as a shareholder, I have received 25 lakhs from the company. I have purchased these shares for 3 lakhs. Today, company has gone into liquidation and they are giving me 25 lakhs. My purchase price was 3 lakhs. So I may feel 25 minus 3, 22 lakhs is my capital gain. No. What 222C has told me, shareholder has received 25 lakhs. Out of this 25 lakhs, 20 shall be treated as dividend in the hands of shareholder. 20 lakhs shall be taxable as dividend income. 5 lakhs shall be treated as he is receiving money in lieu of his, as I say, sale price of the shares. 5 lakhs shall be treated as sale price of shares. He has purchased the shares for 3 lakhs. Sale price would be 5 lakhs. 2 lakhs would be the amount of capital gains in the hands of shareholder. Okay. So listen to it again very, very carefully. Now what is happening? From the angle of shareholder, now we are deciding it. With respect to the, from the angle of company, we have seen only one thing, that section 46(1). If company distributes its assets in a kind of form to its shareholders at the time of liquidation, this is not treated as transfer. No capital gain liability shall be there on the company. Now, from the angle of shareholder, my company has gone into liquidation. In the lieu of my shares, I have received a 25 lakhs rupees from the company. I have purchased these shares for 3 lakhs rupees. I have received 25 lakhs from the company. So one may feel that my shares are now going out, my rights are getting extinguished, my shares are getting extinguished, worth a 3 lakh share, I am getting 25 lakhs. So 22 is my capital gain. This would be the normal understanding. But law says no. Whatever amount you are receiving as a shareholder from the company at the time of liquidation, that total amount shall not be treated as a sale consideration for your share. That total amount shall not be used for calculating capital gain. Whatever amount you are receiving, some part of it would be treated as dividend, balance part would be treated as sale price of your shares. Okay, listen to it again. As a shareholder, whatever amount I am receiving at the time of liquidation of the company, some part of it would be treated as dividend, balance would be treated as a sale price, as sale consideration of my shares. How much amount would be treated as dividend? The amount of accumulated profits with the company just before the start of the liquidation. When the liquidation has started, whatever was the amount of accumulated profits of the company, to that extent, whatever I have received, that will be treated as dividend. Okay. So say for example, we can simply generate a simple example for this whole discussion in order to give you a better idea. Let me open an Excel sheet here. Okay. So these were two shareholders. Both were having 5,000 each shares, 5,000 shares of a company. A has purchased these 5 shares for 1 lakh of rupees. B has purchased these 5,000 shares for 2 lakhs of rupees. Okay. Company has gone into liquidation and both of them have received 12 lakh 50,000 from the company. At the time of liquidation, both have received 12.5 lakhs from the company. Normal tendency would be, if I have not read the provision carefully, I will feel that, okay, for my 5,000 shares, I'm receiving 12 lakhs 50,000. I have purchased these shares for 1 lakh. Now I'm receiving 12.5. So balance 11 lakh 50,000 would be the capital gain of A. 10 lakh 50,000 would be the capital gain of B. This would be the normal understanding. Now, this is not correct. This is wrong. This is where we need to develop an understanding. Law says that whatever amount they have received, that will be a part of this would be treated as dividend. So how much would be treated as dividend? The company's share capital was, say for example, 10 lakhs and profits were 20 lakhs. As on the date of commencement of liquidation, 10 lakhs was the share capital, 20 lakhs were the profit. As against this, now company has distributed total 25 lakhs among the shareholders. So what will be the position? Company's profits were 20 lakhs. Mr. A has received 12.5 lakhs. Out of this 12.5 lakhs, 10 lakhs will be treated as received on account of dividend. Each one has received 10 lakhs on account of dividend. Balance 2.5 lakhs is the amount of sale consideration. So Mr. A has purchased the shares for 1 lakh. He has received now 12.5. Out of this 12.5, 10 lakhs would be treated as dividend. Balance 2.5 lakhs would be his sale price minus 1 lakh, 1.5 lakhs capital gains for A, 2.5 minus 2, 50,000 would be the capital gain for Mr. B, subject to the concept of indexation. Dividend is also taxable. Now from this year onwards, dividend is also taxable in the hands of shareholder. So both will be paying tax on this 10 lakhs as their dividend income, and then each of them would be paying tax on the capital gains based on his purchase price. Why this differentiation is important? Because we know capital gain is subjected to indexation and taxable at a different rate. Dividend income, part of my other sources, that is taxable as per my slab rate of taxation. Okay, so again a bit complicated part of it, but if seen a bit with a bit alertness, then you should be able to get the concept. The whole idea is this: at the time of liquidation of the company, whatever amount has been received by the shareholder, that total amount cannot be treated as a sale price of their shares. Whatever amount they have received, some part of it shall be treated as dividend, remaining shall be treated as sale consideration of their shares. How much amount would be treated as dividend? The amount of profits which were there with the company as on the date of commencement of liquidation, to that extent, amount distributed by the company shall be treated as dividend. This is what is the whole idea related with this whole liquidation of the company. Okay, whether from AY 21-22 such dividend is taxable. Nitesh question, I think I have already answered it. Whatever are the dividend, that these dividends are also taxable in the shareholders, and then the balance amount shall be used for calculation of capital gains in the hands of shareholders. Okay, fine. So this is all about this taxation of company in our today's session, assessment of companies, our today's session. After this, then the next topic related with the company taxation is provisions related with the MAT, minimum alternative tax. That discussion we shall be having in our next session. In today's session, we have tried to cover some very important concept. Most important is related with the surcharge and marginal relief calculation. Okay, try to do some more practice on this whole marginal relief issue. Try to develop a real grip on that part of the discussion. Apart from marginal relief, we have discussed about this new sections: optional rate mechanism, 115 BAA, 115 BAB, the provisions related with the buyback tax, and then this treatment at the time of liquidation of the company. Okay, I think we can close down our today's discussion at this point of time. Next session, we shall be talking in detail about the minimum alternative tax. Any queries related with the today's discussion? We have got time available. We can discuss it through chat box. Yeah, go ahead with the queries. Okay. With respect to accumulated profits, what is meant by whether capitalized or not? Okay, in case of liquidation of company, even if certain profits have been capitalized, okay, company has issued bonus shares by capitalizing their profits, still that will be treated as part of accumulated profits for finding out quantum of dividend. Sumit from Jaipur. Yeah. Any further queries? Yeah. Sumit, I think we can have a separate discussion on this. I have already answered my view on this part. Okay. So no further queries. I think we can close this discussion. I will be taking 3 more sessions. So you are having any further queries, we can discuss it during the course of remaining sessions also. Okay. Thank you very much, everybody. Good night.